There are 10 stocks that do better than all the other ones every year, and Bankrate.com has just released their data on which stocks did the best and which stocks did the worst so far for 2025. People think the most magical part about the holidays is a guy in a red suit breaking into homes and leaving things for them to find in the morning. That's creepy. The two most magical things about this time of year is number one, we get to slow down and reflect. The whole year gets so chaotic, and this year was no different. Tariffs, interest rates, job reports, government shutdown, a temporary reopening, and now reports are coming in talking about the Bank of Japan raising their interest rates again. The last time that happened, the markets did not like it. But for the moment, we can take a second and remember, no matter how wacky it gets, we are all incentivized for the same thing: slow and steady long-term growth. And number two, it's the time of year where Mariah Carey de-thaws from the ice block she's been trapped in and makes over $2 million in a single month for a song released back in 1994. So we'll talk about the 10 best stocks of 2025, the worst performers of the year, the story behind why they did well or didn't do well this year, the trends we're seeing from this data, and we'll compare this year's best stocks to last year's best stocks. But first, we'll answer the question, how does Mariah Carey and her Christmas album make us better investors? Hi, I'm Raj. On this channel, we talk about money, and a pretty good year for the S&P 500 seems to be close to wrapping up. From the data we still have about a month left, but historically, anything above a 10% gain is considered really good. And as of recording this video, we're close to a 16% gain for the year. Now that's peanuts for Nancy Pelosi, and honestly, I'm not really sure what we can learn as investors from her, other than it pays to get into politics. I'd rather focus on something slightly more practical: how Mariah Carey is reportedly going to make over $2 million this year from a song she recorded over 21 years ago. The crazy thing is, she doesn't have to sing it again. It just has to be played enough times over and over, and the fractions of pennies per stream start adding up to more than most people make in their lifetime. Look, it's a certified Christmas banger, no one is denying that, and there is a lesson here for us as investors. Here's what most people miss about this. It's not just her making the money. Most artists make songs through a record label. That means the label, the producers, the singers, the songwriters, everyone involved came together at one point in time to make songs which turned into an album, which was released and then listened to millions of times over. In the modern day of music streaming, every time a song gets played, a little bit of revenue goes to the people who helped create it. It's why Taylor Swift re-recorded a ton of her albums to make Taylor's version. She owns all her stuff now. So how does this apply to us as investors in stocks? Here's what I noticed. If we buy a stock, we own a little part of the company, kind of like owning a little part of a song. So when they make money and the value of that company goes up, the part we own goes up in value as well. The more we own, the more it goes up in value, the more we make. Have yourself a merry little Christmas. Since I'm not a generational singing talent, my best bet is to put my dollars to work in the market. Your money probably goes there too. And that brings us to our number 10 best performing stock this year, Intel. It's up 105%. So Intel is one of those companies that I saw a ton growing up. It's a bit odd because Intel makes parts for computers, not exactly kid-friendly. But on every computer I saw, there was always a sticker that said Intel inside. And in the day and age of AI, Intel has gained some ground, which led to a huge market performance this year. The question is why? Well, there's three main reasons. This year, NVIDIA invested $5 billion into Intel. SoftBank invested $2 billion, and the US government bought 10% of the company. This is overwhelming backing by companies, their dollars, the US government too, so of course the markets loved it. Hold on to Intel. At the end of this video, you'll see something really surprising. Next up is Amphenol, up 100.9%. Now, I've never heard of this company before making this video, and maybe you haven't either, so long story short, they make parts for electronics. They don't make the flashy stuff like iPhones or Teslas, but they make the stuff that makes all of that stuff work. Their connectors, sensors, wiring, everything they make is needed for AI data centers, our 5G infrastructure, electric vehicles, and of course, our national defense. Why the stock doubled this year is because they bought a bunch of other companies. This allows them to expand further in growth sectors of the market, but also broaden what they can do so they're not as concentrated. Number 8 on the list is Lam Research, up 114%. And this company does something very interesting. They don't make CPUs and GPUs, the chips we've heard so much about with the rise of AI. They make the machines that make the chips. In other words, they make tools for other people who make tools. So why are they up this year so much? Pretty simply put, chip makers are wanting to make more chips. This increases demand for their tools, which Lam Research makes for them. Number 7, Palantir, which is up 121%. Now, Palantir is a well-known company, but to keep it simple, they make software that allows companies to make sense and use the data they have. Companies can feed Palantir software their company data and make decisions and changes based on that instead of just guessing. So why the surge in price? Well, this year, Palantir reported a huge demand in the commercial sector. So it's not just working with government contractors anymore. The private sector wants their product too. This leads to more revenue for the company and a higher value in the market. Number 6, Warner Brothers Discover, up 126%. This is a media company. They own HBO Max, CNN, DC Comics, Food Network, and in short, they own media and make money distributing it. Why it's up this year is because it's announced a splitting up of the company. One side is going to focus on streaming and studios, which is HBO Max, TV, and film production. The other is going to focus on global networks or news, sports, and entertainment channels. This split started drawing a lot of interested buyers for the content they owned, and this demand was seen as a positive sign for the company, which turned into increased market value. Number 5 is Newmont, up 138%, and this company mines, processes, and sells gold, as well as silver, copper, and other metals as well. So why is it up? First, they produced 1.5 million ounces of gold in the first quarter of the year and had $1.2 billion of free cash flow. They sold off a lot of their assets to streamline the business, paid dividends, and bought back shares. All of that combined with the rise in price of precious metals this year meant that Newmont was a hard-to-beat stock this year. But the next 4 companies did beat them in terms of performance. Number 4, Micron Technology, up 173%. And this company makes memory products for semiconductors. That's data storage for AI devices, computers, cloud servers, and probably the device you're watching this video on. So what drove the stock up? You probably guessed it, there's an increase in demand for their products because of the increase in AI data centers. Number 3, Seagate Technologies, up 217%. This company makes high-capacity data storage, specifically hard drives. And not to sound like a broken record, but they're up because of cloud data center growth and AI infrastructure. Number 2, a little different, Robinhood Markets, up 233%. Obviously, I'm biased. I use Robinhood for investing, and I just got their gold credit card, and they're an app-based brokerage, and apparently trying to be your bank too. Why they're up this year is due to growth. Users deposited $18 billion onto the platform, and Robinhood Gold subscriptions are up. In addition, they're expanding their products to appeal to more advanced traders, and the SEC did not enforce penalties and has closed its investigation into Robinhood's crypto business, which has been a source of growth for the company as well. And number 1 this year, Western Digital, up 261%. They provide data storage, specifically hard drive storage, for data centers, cloud providers, businesses of all kind. And long story short, they're up because an increase in demand because of AI. The overall theme this year was AI and data, and I'm pretty sure the losers of this year will likely have nothing to do with AI. But first, how did the Mag 7 do? That's Microsoft, Apple, Google, Nvidia, Tesla, Meta, and Amazon. No surprise, they're all up. Amazon up 5%, Meta and Tesla up about 10%, Apple up 12%, Microsoft up 15%, Nvidia up 30%, and Google up 68%. Now, the crazy thing about these companies being up is their valuation. These percentage increases in dollar amounts are incredibly high. Now, the other side of the coin, the worst performing stocks this year were Molina Healthcare, down 50%. This company provides health insurance, and the problems are rising healthcare costs and worse margins for profits. Lululemon is down 51%. They're a clothing store, and they're down due to increasing costs, slowing demand, and brand fatigue, which means that for some people, it's not as cool as it once was. I still wear my Lululemon pants. I'm loyal like that. Gartner is down 52%. They're a research and advisory firm, and they're seeing slowing growth as companies move towards AI for their research and advising needs. Deckers Outdoor Corp is down 57%. They sell footwear, clothes, and accessories. They own UGG and Hoka. They're down due to rising costs and slowing demand. The trade desk is down 66%, and they're in the digital ad space. They're down because there's a slowdown in digital ad spending, and that's forced a revaluation of the stock's price. And finally, Fiserv. This is down 70%. They provide payment processing, banking tech, and other services for merchants and financial institutions. They're down this year because they missed their earnings, which means the company wasn't growing as much as investors anticipated, leading to a decline in price. So looking at all of this, there's a few really clear patterns between the winners and the losers this year. First, the winners were all riding the same wave. If your company had anything to do with AI, data centers, or the infrastructure that powers AI, you printed money this year. Didn't matter if you made memory chips, hard drives, chip-making machines, or even the tiny connectors inside all those systems. If AI needed your product, your stock was probably up. This year was all about the picks and shovels of the AI gold rush. Second, companies that simplified, cleaned up their balance sheets, or unlocked hidden value did well. Newmont sold assets and boosted cash flow. Warner Brothers split itself up and attracted huge buyer interest. Robinhood grew users and got regulatory pressure lifted. Moves that made companies leaner or more focused were rewarded. Now on the flip side, the losers tell a completely different story. First, if your business had nothing to do with AI, you were basically invisible this year. Retail, clothing, footwear, insurance, healthcare, none of those benefited from the AI boom. Second, rising costs and slowing demand crushed consumer brands. Lululemon, Deckers, Molina, they weren't falling apart as companies, but margins got squeezed and demand slowed. In this environment, that's enough to tank a stock. And third, if a company didn't meet expectations, they were crushed. Fiserv, The Trade Desk, Gartner. One bad quarter and the market had zero tolerance. Investors punished anything that didn't show strong growth or profitability. The winners were companies riding the AI and data boom, building the infrastructure for the digital world, while losers were traditional consumer businesses facing rising costs, slowing demand, or getting disrupted by that same technology. Now, compared to the last year, there was only one repeat of the best performing stocks, that was Palantir, and zero repeats for the worst performing stocks. But there was an interesting finding. In 2024, Intel was down about 50%. It was one of the worst performers last year. And this year it's up about 100% for the reasons we went over earlier in the video. So it just goes to show it's hard to predict trends and the individual winners and losers, but on occasion we see a trend change. Now, I don't know how the Japan carry trade, a government shutdown resuming next year, or any other once-in-a-lifetime financial event will affect us, but what I do know is that we'll probably be okay in the long run if we hold on to the ride like an elf on Santa's sleigh. So I can't give you financial advice, but I can tell you the more data I see, the more I realize I'm terrible at stock picking and short-term trading as well, and I cannot predict the future. Your guess is as good as mine. I'm almost always better off buying an ETF like VOO and just letting the market work for me. Let me know your thoughts. I hope you made a bunch of money this year. I'll see you in the next video.